commodities, whether they are related to food, energy or metals, are an important part of everyday life. Commodities can be an important way to diversify a portfolio beyond traditional securities, either for the long term, or as a place to park cash during unusually volatile or bearish stock markets, like it's happening right now. Reason for that is commodities traditionally move in opposition to stocks. As the essential components behind just about every other product imaginable, commodities are vital to modern economies. Hi everyone, Basic Investor here. Today we are starting a short series about commodities. Commodities are the essential components of other manufactured goods, the building blocks for both industrial and domestic products and foodstuffs. They are shipped around the world to meet demand, because not all countries are capable of producing every commodity they need. The production and consumption of commodities depends on factors such as climate, season and resources, both natural and man-made. Demand is also influenced by a complex interaction between economic factors and consumer habits. Because of this, commodity prices have the potential to fluctuate greatly. Commodities are generally traded in very large quantities, either on the cash market or, more frequently, on the futures exchange. Commodities history. Actually, commodities dealing is an old profession, far older than dealing in stocks and bonds. Ancient civilizations traded a wide array of commodities, from seashells to spices. Commodity trading was an essential business. The might of empires can be viewed as somewhat proportionate to their ability to create and manage complex trading systems and facilitate commodity exchange, as these served as the wheels of commerce, economic development and taxation for a kingdom's treasuries. Who trades commodities? There are generally four groups of traders who use commodities. Hedges. Investors often buy or sell commodities to help manage their risk. In a balanced portfolio, commodities provide a hedge against downward movements in other securities, as they tend to move in the opposite direction, or in unconnected direction, to certain stocks and bonds. Speculators. Investors with a particular opinion on a particular commodity are willing to take on the associated risk in the hope of turning a profit. Producers. People that grow and harvest commodities may want to enter into a futures contract on them in order to offset the risk of future price movements. And brokers. These are firms or individuals who carry out the order to buy or sell commodity contracts on behalf of their clients. Now, let's see some terms here. Commodity speculation. Major commodities tend to trade in very large quantities, and it would be unrealistic for most traders to process them. Instead, and especially because of their volatile nature, commodities are often used for speculation on their prices. They trade on the commodities market, which is made up of a number of international commodity exchanges. In the commodity market, as opposed to the stock market, everything expires. This is because the commodity will eventually need to be delivered to its final owner. Commodity futures. Futures contracts provide a number of benefits that entice both buyers and sellers. Leverage. Futures trade on margin, meaning that investors only have to put up a fraction of the total value in order to trade. Types of commodities. Today, tradable commodities fall into four categories. They include metals including gold, silver, platinum and copper, energy including crude oil, heating oil, natural gas and gasoline, livestock and meat including lean hogs, pork bellies, live cattle and feeder cattle, agricultural including corn, soybeans, wheat, rice, cocoa, coffee, cotton and sugar. Volatile or bearish stock markets typically find scared investors scrambling to transfer money to precious metals such as gold, which has historically been viewed as a reliable, dependable metal with conveyable value. Precious metals can also be used as a hedge against high inflation or periods of currency devaluation. Today we will focus on metals, such as gold and silver. Consider weakening currencies, international tensions and natural disasters in a world where light-speed communications can turn any geopolitical murmur into a major shock to the financial system. Physical gold, silver, platinum and palladium provide protection against these major financial shocks by creating a strategically balanced investment portfolio. Why buy physical gold, silver? When you buy precious metals, you invest in an asset class that is as old as civilization itself. Not surprisingly, these ancient storehouses of wealth can play important roles in a modern portfolio. Because the global supply is relatively finite, gold's relative purchasing power has historically remained stable during inflationary times. As we can see, 0.072 oz of silver buys as much gasoline in 2014 as it does in 1930, even as the price in dollars increased by 3,600%. There you can see that precious metals prices generally move independent of stocks and bonds. In a downturn, they could provide the one bright spot your portfolio needs. Their low correlation to other assets makes precious metals ideal for balancing any portfolio. Market timing is difficult for any investment. That is one reason many investors look beyond day-to-day price movements and buy physical gold or silver as long-term investments. When planning to hold an asset like physical gold for 3-5 years or more, it is less important to consider the current cost of the metal and more important to examine its historical performance in relation to other investments. How much should I buy? Like many investments, buying precious metals depends on your budget, objectives, time horizon and other factors. Some financial professionals recommend keeping 5% to 10% of your investable assets in bullion and maintaining that percentage through regular rebalancing. It can make a difference in overall portfolio performance. Some say more, in my case that goes up to 20%. You may allocate more of your portfolio to gold and silver if you wish to. Hold physical assets that aren't necessarily listed with your paper investments. Provide a gift of substantial value to children, grandchildren or others. Hold extra insurance against events that may upend financial markets. Buy collectible coins for their beauty, history or other intangible factors. And for the end, I'd like to say this was the first episode in the series on this subject. Next week we will continue our journey into trading with commodities, more precisely gold and silver, where we will talk about buying silver, where, how and which types of the bullion silver are the best to start with. That was all for this episode. I hope you enjoyed watching this. If so, please leave a like and comment what do you think about precious metals market and should the one consider getting into it. Thanks for watching and until next time, this is bye from me.